Welcome back to the Real Estate Investment Growth course. If you're watching from USA, Canada, UK, Middle East, Pakistan, India, or anywhere in the world, today's lesson is exactly what will turn into an intelligent, cycle-aware investor. Part 2 is all about market cycles, demand drivers, and the forces that shape real estate prices globally, and especially how they behave in the United States. According to data from the National Association of Realtors (NAR), global real estate trends are influenced by up to 70% by US interest rates, construction activities, and economic cycles. So, even if you invest outside America, what happens in the US still affects your local property values. This episode will help you understand when to buy, what to hold, and when to wait, using global patterns backed by realistic examples and real world market behavior. Make sure you watch till the end, and if you're from the US, hit the subscribe button because this series is built with you in mind. Every real estate market in the world follows a similar cycle: expansion, peak, correction, and recovery. The US housing cycle is the most studied, and research from the Harvard Joint Center for Housing Studies shows these cycles last roughly 8 to 12 years, depending on interest rates, supply-demand balance, and economic stability. During the expansion phase, prices rise, inventory shrinks, and construction activity increases. This has been seen in the US from 2012 to 2019, where home prices climbed almost 50%. At the peak, affordability drops and buyers reduce activity. Then comes correction, like the 2022 to 2023 slowdown triggered by rising US Federal Reserve interest rates. And finally, markets enter recovery, where prices stabilize and buying restarts. These cycles don't only apply to the US. Global markets such as Dubai, Canada, UK, Turkey, Pakistan, and India mirror these trends within months. Understanding this cycle protects you from buying at the top and losing money. If there is one force that shapes global real estate prices, it's the US Federal Reserve. When the Fed raises interest rates, mortgage rates rise not only in America but in 90% of global markets, according to the World Bank Global Debt Report. Here's the chain reaction: higher Fed rates, higher US mortgage rates, home affordability drops, US home sales slow, and global bank flow. Mortgages get expensive worldwide, property demand declines, and investors become cautious. Prices cool down across global markets. This exact pattern was seen in 2022 to 2023 when the Fed hiked rates aggressively, pushing the US 30-year mortgage to above 7%, the highest in 20 years. Freddie Mac data. Canada's housing market froze. UK prices corrected 5 to 9%, and Dubai's price growth slowed temporarily. Even countries like Pakistan and India saw slowdowns in luxury segments because global investor liquidity shrank. If you want to predict world real estate, watch the Fed first. Understanding demand patterns is the US helps predict future prices globally. According to Zillow and Redfin data, demand spikes occur when mortgage rates fall, job market strengthens, inventory drops, millennials and Gen Z enter home buying age, rent prices rise faster than home prices. The US currently has a housing shortage of over 4 million homes, as reported by Freddie Mac. This shortage keeps prices elevated even during slowdowns. When US demand rises, global investor confidence improves, leading to capital movement into markets like Dubai, Toronto, London, and beyond. And when US demand weakens, as seen in late 2022, global markets become cautious. If you want to forecast big shifts in worldwide real estate, follow US inventory reports, mortgage applications, rental indices, and job numbers. They act as global early warning system.
Well, viewers, if you didn't subscribe to our channel yet, please subscribe now.
Migration patterns inside the US offer powerful insights for investors anywhere. The US Census Bureau and U-Haul Migration Trends Report show millions of Americans leaving high-cost states like California, New York, and Illinois, and moving to states like Texas, Florida, Arizona, Tennessee, and North Carolina. These shifts create immediate price changes. For example, home prices in Austin, Phoenix, Tampa, and Miami surged because of massive demand, while San Francisco saw price declines and record high vacancies. Global investors study US migration as a model. Why? Because similar patterns repeat worldwide. When people move toward affordable, lower tax, higher job growth areas, those markets explode in value. This applies to Dubai's migration boom, Canada's Ontario to Alberta shift, and Pakistan's Lahore or Islamabad movement. Where people move, money flows, and where money flows, prices rise. Construction costs have risen sharply worldwide due to global supply chain issues. Data from CBRE and the US Bureau of Labor Statistics show lumber prices doubled in 2021. Steel prices increased over 40%. Labor shortages pushed wages higher. Transport and fuel costs surged. This increased the cost per square foot for builders globally. When construction gets expensive, developers raise prices. That's why US, UK, Gulf, and Asian markets all saw price jumps after 2020. Even if demand is moderate, construction inflation alone forces prices upward. For investors, this means even during slowdowns, property rarely becomes cheap. Pre-construction investments become more valuable. Holding land becomes profitable because replacement cost rises. Always track US construction cost reports. They predict global price floors. International buyers strongly influence US real estate. NAR's Foreign Buyer Report states that buyers from China, Canada, India, Mexico, and the Middle East invest billions yearly in US markets like California, Texas, New York, Florida, and Washington. When global investors increase buying, US prices jump. When they slow down, markets cool. Similarly, when US investors enter gold and global markets, Dubai, Turkey, Cyprus, Thailand, those regions experience sharp upward trends. The US remains the safe haven for global wealth. Anytime global uncertainty rises, wars, recessions, political instability, foreign investment pours into America. This dynamic shapes worldwide real estate performance. When recession fears rise, buyers worldwide behave similarly. They pause. The IMF documented this during 2008 and again in 2020. In the US, mortgage applications drop, home sales fall, buyers wait for clarity, investors rush to rental-focused strategies. Across the world, the same pattern appears, but here's the twist. Property doesn't collapse everywhere. Markets with strong rental demand, slow supply, and global investor flow, such as Dubai, Florida, and Toronto, bounce back quickly. Global markets flow the US recession sentiment. If America signals slowdown, global markets brace for impact within months. The US retail boom is shaping investment strategies worldwide. According to Apartment List and Realtor.com, rents increased more than 20% in key American cities post 2021 due to expensive mortgages, post-pandemic relocations, supply shortages, and high demand from young renters. When renting becomes more expensive than owning, investors jump into rental properties. This trend influenced Dubai's rental boom, Toronto's rising rent, UK's shortage-driven rental inflation, and Pakistani and Indian metro rental spikes. US rental trends are a leading indicator of global investor behavior. If American rents rise, expect other markets to follow. Even with high mortgage rates, the US remains the safest real estate market due to strong legal protection, stable banking system, transparent regulations, strong job market, and consistent rental demand. BlackRock and Goldman Sachs repeatedly report that US property is one of the most reliable inflation hedges. That is why global money flows into America during crises, including COVID, the Ukraine war, and financial instability in multiple countries. Where global capital goes, global trends follow. Understanding the US system gives investors an upper hand in predicting international real estate movements. Global investors gain three key insights from studying the US. Cycles always repeat. Population growth drives long-term value. Interest rates decide everything. US data is the world's dashboard. If you're in Pakistan, India, UAE, UK, or anywhere, you can make the better buying decisions simply by watching US CPI inflation, Federal Reserve announcements, NAR monthly sales reports, mortgage rates updates, and construction cost reports. These shape global price behavior. Smart investors study the US not because they want to buy there, just because US trends predict global outcomes. This completes part 2 of your real estate investment growth course focused on USA plus global trends. Understanding the US market gives you the power to read global real estate like a professional analyst. In part 3, we will explore location mastery, how to identify high growth hotspots in any country. So before you go, hit like, share and subscribe, especially if you're watching from the USA. This course is designed to upgrade your financial future step by step.